Hey there, what is going on, gang? Happy Tuesday to you. Hope you all had a wonderful Valentine's Day yesterday. Thanks so much for joining me. Welcome to SRT Live with me, your host, Sean Richard. Glad you could make it today. And I am here with your weekly update on all things real estate and mortgage related. I'm going to be perfectly honest with you. I tend to lean on the side of the data, and I talk a lot about the economic conditions that drive our markets. But when you want to sound wicked smart for your clients, and when you're having other conversations, this is the place to start your Tuesdays. So thanks so much for joining me. So let's get into it. We've got a pretty heavy slate of information today. We're covering a little bit of everything. As always, inflation is at the top of everybody's minds. And we are also going to be talking about what the Fed is looking to do going forward. And I've talked quite a bit about this, and it's such a hot topic. And it's really fascinating. Really, the next probably 30 to 45 days in the mortgage and real estate industry is going to be incredibly fascinating. And I may be the only one that thinks that, because I like to nerd out on this stuff. But if you'd like to join me in nerding out, then we can definitely do that. So let's kind of dive into it. Let's talk about last week, the information that we got. So every Thursday, we get initial and continuing jobless claims. These are unemployment claims. And so the initial unemployment claims, these are people that are filing for unemployment for the first time. And so last week's data was for the prior week. So the market was expecting 230,000 initial jobless claims. We actually only got 223,000. So a little bit of a miss to the positive side there. Less people filing for employment by 7,000. So yes, it was a miss. It wasn't a significant miss. Didn't have too significant of an impact on the markets. But as always, we want to look at initial claims. We want to watch the trend. The week prior to that, we had 239,000 jobless claims. And so we had a decrease of 16,000 from week to week, which is, I would say it's significant, but it's definitely not super minor either. And then the second component of this is the continuing claims. So these are individuals that are continuing or renewing their unemployment benefits. And so the expectation from the market, from analysts, was 1.615 million. So just a hair over 1.6 million. We actually got pretty spot on. We got 1.621 million. So a little bit higher than expected, but again, within the realm of that of where the analysts were expecting. Actually came in exactly in the same position that it was the prior week. 1.621 million is what we got the week before as well. Now, if you were watching my update on Thursday, you saw me talk about the CPI, Consumer Price Index. And this, again, is the level of inflation, or I guess a report that tracks inflation. This is put out by the U.S. Department of Labor and Statistics. And this measures inflation at the consumer level. It measures a basket of goods. So the example that I gave last Thursday was, if you go to the grocery store and you buy 25 items, and then every month you go to the grocery store, you buy the exact same 25 items, over time, you're going to be able to gauge whether the price of those goods are going up or down or staying the same. And so that's pretty much what this CPI, Consumer Price Index report, measures. It's measures the price on basket of goods at the consumer level. And so it came in smoking hot month over month. The market was expecting 0.5%, and we actually got 0.6%. So that was pretty hot inflation. Only a 10% over the expectation. But when you combine that with the last 11 months, and we look at the year over year rolling average, we were at 7.5%. And that was up from the expectation of 7.3 That was up from the previous month's reading of 7%. And so inflation is running hyper high. The Fed, the Federal Reserve, Federal Open Market Committee, is going to have to take action. And you've heard of them talking about rate hikes, and they would look to do that to help curb inflation. So we'll get into that a little bit more later in this update. But inflation super high. Now, what did we get today? Well, today we got PPI. So last Thursday we got CPI, Consumer Price Index, and then today we got PPI, which is the Producer Price Index. So this report, also from the U.S. Department of Labor and Statistics, measures inflation at the producer level, at the manufacturing level. And so this report also came in smoking hot. Now, not unexpected, because inflation has been running extremely hot across the board. We've got supply chain issues that are really driving that up. We've got wage pressured inflation, and all of these components go into just the general inflationary, movement in our economy. So PPI, Producer Price Index, month over month, the market was expecting a 0.5% month over month increase, in producer inflation. It came in at 1%, double what the market was expecting, which is pretty massive. And then the market was actually expecting a 9.1 year over year rise, and we ended up at 9.7. Now, this is actually a tick down from the previous month's reading of 9.8, but we're still running crazy hot on inflation, even at the producer level. Now, you might say, well, wait a second, Sean, why is the producer inflationary report, why is it so much higher than the consumer inflation report? And there's a number of reasons for that, and I'll give you a couple. Number one, producers may not always pass that cost on to the consumers. If I'm a business, if I'm a manufacturer, and my cost of producing my goods or services increases, in order for me to stay competitive, I may not want to pass that entire cost increase on to my consumers. I may say, you know what, I'm only going to pass 80% of that cost increase on to the consumers, and I'm going to absorb 20% of that. My margins are going to go down, but I'm hopefully making that decision because I want to stay more competitive in the marketplace, or I want to be ultra competitive and I want to outprice my competition, who are maybe passing more of any cost increases along to the consumer. So that's a lot of the game really that gets played at the business level as far as inflation is concerned, how much of it gets passed along to the consumer. So big inflation numbers. What we're really hoping for is we're hoping that inflation it peaks and it starts to come back down. You've heard me say this a million times. Inflation is the enemy of interest rates. And as long as we continue to see inflation rising, we're likely going to continue to see interest rates rise as well. All right. So let's look ahead at some data that's coming out this week and how it's going to impact the markets. So tomorrow, Wednesday, we've got a couple of pieces of information. We've got the NAHB Housing Market Index. The NAHB is the National Association of Home Builders, and they put out their sentiment on a monthly basis. And this basically gauges whether home builders are optimistic or pessimistic about the future of their business in the housing market. And so the higher this number is, the more optimistic that builders are. And I think with the housing dynamic that we have right now, where we've got such low supply and we've got such high demand, I think we're going to see that number come out pretty high. I think builders are going to stay optimistic about the market and where their business is going to be. So the NAHB Housing Market Index is coming out tomorrow. We also, more importantly, get the Federal Open Market Committee meeting minutes. Now, this is from their meeting last month. And so they've already had their meeting, and Jerome Powell, the Fed chair, has already spoken about has already come out and done a press conference about it. But the meeting minutes really give us a more granular picture into what went on, what they talked about, some of the decisions made. And so the meeting minutes, although it's post meeting, it's going to allow the market to digest the information from the most recent Fed meeting in a different way. So the meeting minutes very much could be a market mover if it reveals any information that maybe wasn't talked about in Jerome Powell's press conference. So that coming out tomorrow, and that's at 1 o'clock Eastern, is when those get released. That could potentially be a market mover. And all right, so let me see if there's any comments here in the stream today. Not at the moment, no worries. If you have any questions, don't hesitate to comment below. I am checking the comments on the Facebook page, so feel free to ask questions and I'd be happy to get those answered as I have the ability. So that Wednesday, we talked about that. Thursday, as always, every Thursday, we're getting jobless claims. That's unemployment claims. So again, we want to look at the trend. This is a weekly report, so the trend is more important than anything else there. The health of the employment markets is really, that picture is painted on a weekly basis. We're also getting housing permits and housing starts. And this is some two great reports that really give us an indication of what builders are doing, because this shows us the initial details of what will eventually be new homes sold, right? So a builder, when they're getting ready to put up a home, they're going to pull permits. They're going to submit for permits in order to do that. And so getting that permit report is going to give us an indication of builder activity at that permit level. And then starts is actually new home construction starts. So we're seeing, the pipeline on permits and then starts. And so getting a gauge of where these numbers come in is going to give us some ways to predict what new home sales are going to look like in the future. Now, when in the future is kind of a big question, because we know builders are struggling with supply chain issues. They're struggling with being able to obtain labor in a timely fashion. So the timeline for new builds is quite up in the air right now for those reasons. And we also get existing home sales as well. Existing home sales is the reporting on the number of single family resident existing homes sold for the prior month. And so here we also want to take a look at the trends, because we've got very low inventory, right? And so if we've got low inventory, if there's just not enough homes on the market to meet the demand, then that very well could bring down the existing home sales. If we don't have more homes, we can't sell more homes. And so that's going to be an interesting one to watch. And again, this is a monthly report that we want to keep up with. So that comes out later this week as well. All right, so let's dive into the $1 million topic, which is mortgage rates. Now, of course, I'm not going to be able to give you exact mortgage rates, on this today. All kinds of fun other disclosures that I've got to give you when that happens. But I want to talk a little bit about the direction of mortgage financing, where rates are likely headed, and some of the factors that could influence those rates, both short-term and long-term. And so we've seen rates come up significantly in the last couple of weeks. And I'm actually going to share my screen with you here in a minute. I'm going to pull up the mortgage-backed security chart. And I share this from time to time. And this is going to be a chart of mortgage-backed securities. I'm not going to go into a whole lot of detail and bore you with a ton of information on this, but I do want to at least show it to you. And then I'm happy to connect with you separately one-on-one to talk more about what this means, what this looks like. So let me pull this up and share it with you right now. Boom, here we go. All right. All right, so this is a chart of the mortgage-backed securities. This is the 30-year 3% coupon. Again, not going to go into a lot of granular detail about everything and what all this means, but if you've seen me go over these charts before, what you know is that mortgage-backed security prices have an inverse relationship with interest rates. And so the real thing that I wanted to illustrate here is you can see that from really the end, right at the end of the year, beginning of this year, we have seen the price of mortgage-backed securities come down. And so we are just in a complete downward trend here. And that's a lot to do with inflation. Again, inflation, the enemy of interest rates, and inflation's been running really hot and it's driving interest rates higher. Now, all of these fun little horizontal lines that you see here acts as levels of resistance, either a ceiling of resistance or a floor of support. So mortgage-backed security prices usually trade between those ranges unless something acts upon them, economic data, an event. And so we've been just flying through these levels of support. And now we've hit this really big one down here. And so hopefully we hold, because if we don't hold here, then rates are probably going to get a healthy amount higher. Now, over the last couple of weeks, we've seen the rates increase by upwards of 0.5%. And all of the buyers out there, Mark, if you're a real estate agent, your buyers are definitely feeling this. If you're a home buyer, you're absolutely feeling this. If you're a homeowner, then you're thrilled because you have a locked in rate and you're good to go. But it's really eroding affordability. And it's not just the mortgage rates, it really is also the home prices. We all know that inflation in home prices is pretty significant right now. Home prices are rising at a pretty excessive, or I guess really a significant clip. I wouldn't necessarily call it excessive, but it is quite high. And so it's, between prices rising and mortgage rates rising, it definitely is eroding affordability for home buyers. And it's a lot of times home buyers feel like they're being priced out of the market. Not so many homes in that $250,000 range in a lot of areas in the Metroplex. And I'm seeing a lot of buyers having to go higher on payment than they'd really like to go in order to get into a home that works for them. And so in the short term, what are we going to see? So why have the rates been rising? Well, inflation obviously is one of them. Also, at the last Fed meeting, the Fed talked about reducing its balance sheet. Okay, so what does that mean, reducing its balance sheet? So the Fed has been buying in pretty massive quantities U.S. Treasuries and mortgage bonds for quite some time. And the mortgage bond prices that I've been talking, that I just showed you the chart of, is very similar to stocks, right? The stock market, stocks and bonds. And so when a stock is sold at large quantities, that stock price comes down. Well, and mortgage bonds work very similarly. When mortgage bonds are sold in large quantities, then the price of those mortgage bonds go down. I told you that they have an inverse relationship with the interest rates, so rates go up. So the Fed has come out and said at the press conference after the January meeting, they said that it might be appropriate to start reducing their balance sheet. And really what the market took that to mean is it may be appropriate to start selling the bonds and treasuries that the Fed holds. Well, if they start selling large quantities of mortgage-backed securities, of mortgage bonds, then the price of mortgage bonds are going to go down and interest rates are going to rise. So there's some risk there. Now, this isn't the only influencer of mortgage rates. There's other things that the Fed's doing. The Fed is talking about increasing the Fed funds rate, which again is the short-term lending rate. So like when banks lend to each other overnight, the Fed funds rate dictates that. It does not have a direct influence on mortgage rates, even though a lot of people think that, oh, well, hey, they adjusted the Fed funds rate or prime rate, and so that means interest rates went up or down. Not the case at all. It has an indirect relationship. So if the Fed increases the Fed funds rate, a big part of the reason that they're looking to do that is to curb inflation. And if inflation does peak and start to come down, we may see some improvement or some help in mortgage-backed security pricing, which ultimately could help interest rates. So we've got a few things that are really pulling in different directions. We've got inflation that if it starts to come down, we would see some help on mortgage rates. However, if the Fed starts to sell its balance sheet, we could see that hurt interest rates. So all of this is happening over the next 45 days. March is going to be a big month because we're expecting to see the first Fed rate hike of the year in March. It was originally slated to be maybe 0.25%. Now there's rumblings that it could be upwards of 0.5%. And we recently got commentary from one of the other Fed members that they see as much as a full percent increase over the course of the year, which is pretty massive. So this is all information and data that's going to influence mortgage rates and where we go. The other aspect that I think we could see longer term. So let me backpedal a little bit here. Let me backtrack and say, in the short term, I believe that we're going to continue to see interest rates rise until we see inflation start to come down. But the caveat to that is going to be what the Fed does with its balance sheet. If it does start to sell, that could reverse any gains that we could get from peaking and reduction in inflation. Okay, so short term, I think we're going to continue to see interest rates climb. Now, what's my long-term outlook? Long term, I think we could be in a position where we see rates come down. And let me give you my thoughts on this. So we have been doing a lot of spending in the economy since the beginning of the pandemic, right? We've had all kinds of money flowing into the economy, PPP loans. We've had the government doing extra unemployment, all kinds of money being spent, trillions of dollars. And so anytime you have significant spending, because what we're doing is we're racking up debt as a country, right? We're increasing the country's debt. Anytime you start increasing debt and you start doing that much spending, at some point, you have to service that debt. And servicing that debt really means making payments, right? So let's assume that you've got a credit card with a $50,000 limit and you go out and you spend $50,000. You rack up, you max it out. So what does that create? That creates instant economic activity. You're stimulating your personal economy. Well, 30 days later, what happens? You get a bill in the mail, and now you've got to start paying for that debt. You've got to start making payments. Well, when you start having to allocate some of your revenue or your income towards making those payments, what happens to your cash flow? It comes down, right? You no longer, if you make 10 grand a month and your monthly payment is $1,000, well, now you only have $9,000 to then create economic activity. Your cash flow comes down and it slows down your personal economy. Our country works the same way. We've amassed all this debt. We've been doing all this spending. At some point, we're going to have to service that debt. And that has the potential. Again, I don't have a crystal ball. Otherwise, I'd own my own island somewhere. But servicing that debt is going to reduce the country's cash flow. It's going to slow down the economy, and it has the potential to lead us into a recessionary period. If that happens, big if that happens, then we could see rates come down. So picture this: the Fed takes action to increase the Fed funds rate to combat inflation. We start to see inflation come down. Then our economy starts to slow down, our GDP slows down, perhaps we end up in a recessionary period, and so interest rates come down. So we may find ourselves, let's call it in the next 18 to 24 months, we could find ourselves in a position where we're in a declining rate environment after this dramatic rate increasing environment over the last 6 to 12 months. Now, does that mean you need to wait and not buy a home right now? Absolutely not, because home prices are not going to stop going up between now and then. So waiting for the lower rate by paying an extra $30,000, $40,000, $50,000, $60,000 on a home doesn't make a lot of sense. Here's what the strategy should be. And I'm big on strategy. The strategy should be, if you can get a home and find a home that works and you can afford the home now, buy a home. And then when that savings opportunity comes up, then we take a look at refinancing to get you that savings. But in the meantime, because you bought the home now, you spend the next 6, 12, 18, 24 months, whatever that time frame is until we potentially end up in that position, you spend that time frame building equity, building wealth. Equity through appreciation and equity through amortization or paying down your loan balance. So long term, I think we could see rates come back down. Now, in the grand scheme of things, I like to remind people back in 2009, interest rates were 5.5% to 6%. As recently as 2018, 30-year mortgages were in the mid fours. And so even though we're in a climbing rate environment, rates are still in a phenomenal position. Heck, the average interest rate on a 30-year mortgage over the last 45 years is somewhere in the neighborhood of 8.5%. So I can't really get too upset with being above all-time lows. So that's the outlook that I have for the market going forward. I think, again, short term, I think we're going to continue to see rates rise. I think long term, at some point in that next 12 to 24, maybe upwards of 30 months, we could find ourselves in a position where rates do decline a little bit. Now, last note that I'll make today, and then I'll sign off for the day, is just want to talk a little bit about inventory. And my thoughts on where we're going to be for inventory in this spring and summer buying season. And ultimately, it's really simple. It's basic economics. We're going to have low supply, and we're going to have high demand. The low supply is going to come from the builders not being able to nor wanting to build homes fast enough. We're also, in this rising rate environment, we're likely to see less people put their homes in the market for fear of being able to buy something else, or those individuals that are maybe not as motivated to buy, they'd like to move, they'd like to make a change, but maybe it's not critical. They may have a hard time justifying higher price, higher rate for the same or smaller home. Now, there's definitely opportunities out there, and there's definitely motivated buyers that are looking for a different school district. They're coming in from other areas. There's definitely reasons to make a change for sure in this market. But I think you could have some lower inventory because of builders and potentially those buyers or those potential buyers that are it's not critical for them to buy. And then on the demand side, we've got people moving in from out of state. I think some of you have heard me say before, I think California is almost empty. It's getting there. So they're coming here to Texas to join us. And then we've also got the millennial generation that has reached first-time homebuyer age, which, again, millennial generation, the largest generation in our country's history. So we've got a mass influx of buying age individuals that are coming into our market. And so that's going to keep demand really high. So I think we're going to continue to see a really, really hot real estate market for some time to come. I think it could be several years. And that also means that we're likely to see home prices continue to rise for another 2, 3, 4, 5+ years, as long as that supply demand dynamic stays the same. And again, I think that's going to be for a number of years to come. I think I read an article the other day that an analyst said that we're likely to be in a similar housing market to where we are right now for another decade. And so if you're a buyer, you're on the fence, or you're thinking about waiting, it's potentially going to be a long wait, and there's going to be a lot of equity that you pass up. And I would much, much, much rather see you gain that equity than pay somebody else for that equity down the road. If you have any questions, you want to talk more about the stats, the details, any information, you want to ask some questions, you can put them in the comments below. You can also reach out to me at my contact information right here. Would love to have that conversation. In the meantime, thanks so much for joining me today on the weekly market update. Have an incredible rest of your week, and I'll be back next week with another update on all things real estate. Take care.